This demo, we're going to talk a little bit about your chart of accounts and what all the different accounts are and what they mean. Going back to some good old basic accounting. It's going to be lots of fun, I'm sure. All right, so we're going to go ahead into your chart of accounts. Okay, notice how your chart of accounts is set up. It is set up naturally when it's sorted here to flow balance sheet information on down to profit and loss information. Okay, so we're going to go through the different types. I'm going to go ahead and say new account. So the first type of account that shows up on your balance sheet is going to be your bank account. Okay, so bank account is, as you noticed over here, it's your petty cash accounts. It's your checking, your savings, your money market, any type of account that is holding cash. Okay, those are banks. So if you have a money market account, if you have a savings account, if you have a CD account, that's a little different. So it's a type of checking account, or it's a type of bank account, but it is actually an investment. It's not an account where you have access to your cash. Okay. So first there's bank accounts. Next on our chart of accounts, moving down, you're going to have your accounts receivable account. Okay, you can have several accounts receivable accounts. You can have multiple. It just gets it a little bit more confusing when you're creating an invoice. Accounts receivable are special types of accounts. You can't post a journal entry, for example, to an accounts receivable account without having a customer tied to it. You cannot go in and once you have that type of account, you cannot change, excuse me, let me right click and edit. You cannot change the account type like you can in other accounts. Okay, so notice I can change the account type. You cannot change accounts to be accounts receivable accounts after the fact. Okay, so it's a little bit of a special account. Accounts receivable, though, is essentially when you create an invoice or you sell something to your customer and you haven't received the cash yet, it's going to go towards your accounts receivable account. Accounts receivable is an asset account. To make it the balance of accounts receivable go up, you need to do a debit. Okay, and I didn't mention that on the bank side, but on the bank side, it's a debit as well. All right, so now we're going to go ahead and go to the next type of account. It is an other current asset. That's the next line item down there. An other current asset, usually when you say current, it means that it's going to be used within a year or it's going to come off your balance sheet within a year. So things such as inventory, I'm hoping that if you're buying something that within a year you're going to sell it. It's also if you have any prepaid expenses, so if you pay insurance up front, you're paying for the entire year. If you're doing employee cash advances, if you're doing any type of retainage or customer deposits, all of those are other current assets. Okay. All right, so next you have your other assets. Those are long-term assets. Okay, so things that would fall into that, you have goodwill, which some people put under other assets, some people put under equity. Any long-term notes receivables, so if you loan money out to someone as an investment, or if you have a security deposit that you put down on your building or your office that you're renting, that is an asset because that's something that's going to sit on the balance sheet, money that's due to you, and it's going to sit there for more than a year. Okay. One type, or I guess a couple types that I skipped over there, you do also have your fixed assets. Fixed assets come in around the current asset area, between the current assets and other assets. The fixed assets are things like your land, your cars, your building. Fixed assets also can be licensing, things that are a major purchase in your business that cannot be expensed because the expense of that item is going to be used over a long period of time. All right, so when we talk about amortization and depreciation, that is what is applied to a fixed asset. So a lot of people ask me, when do I know it's a fixed asset versus when it is a purchase that can be expensed? And the best thing I can tell is to talk with your CPA and decide what your threshold is. So frequently, some of my companies that are smaller companies, I tell them anything that is under $500 can be expensed. Any one item that's under $500 can be expensed. Any one item that's over $500 needs to be a fixed asset. Okay. So if you buy a table and 4 chairs and it is $600, I would still consider that an expensable thing because each individual part is less than $100. But as a whole, some CPAs might want you to have that as a fixed asset. So you want to make sure and talk to your CPA about that. Another example is a computer. So you buy a computer for $1,000. The average life of a computer is 3 years, right? And so you want to make sure that you have it in there as a fixed asset because then you're going to take your depreciation, some in year 1, some in year 2, some in year 3. And that way you can expense the life of the computer over the years that you're using it. Okay? So that's fixed assets. Now if we go down, we're going to be skipping from the asset category now down to the liability section. You know, the balance sheet says assets minus liabilities equals equity. Okay. So you're going to have here your accounts payable accounts. The accounts payable are similar to the accounts receivable. If you're going to have them in a journal entry, you're going to make sure that on the journal entry side of things, under the customer name, actually, it's a little bit different on the vendor side. So if I go in and create a journal entry and I want to put it to accounts payable, under the name here, I'd have to make sure and choose a vendor that it's applied to. It forces me to do that. You can't have a journal entry with multiple vendors applying to accounts payable, so you can't write off a whole bunch of different bills on one journal entry. You have to create a different one for each bill you need to write off because you can only have one vendor name on each journal entry. You can't change an accounts payable account to be a different type of account, and vice versa. You can't change a different type of account to be an accounts payable account. You can't have multiple accounts payable accounts. That's allowed. And essentially what accounts payable is that when you create a bill or you receive some items that you need to pay money for, before you actually cut the check, when you enter it as a bill, it posts to accounts payable on the balance sheet and says that you owe someone some money for something that they provided for you. Okay. So after accounts payable, we do have our credit card accounts. The credit card accounts are things like, Chase, Visa, MasterCard, American Express. These are credit cards that you use to purchase items, okay, or that you use to travel. All right, so those types of credit cards, the ones that incur a liability to your company when you use it. Other things that I've seen used as credit cards when you have an account at Home Depot. All right, so you rack up your purchases during the month, and at the end of the month they send you a statement and you pay it off. So it's similar to having a credit card, but it's an easier way to track it using that credit card feature. All right, and then of course we have other current liabilities. Again, these are liabilities that you want to use or going to be diminished within a year. Things like sales tax. Sales tax only sits on your books for a year before it's due. Sometimes it sits there for a month before it's due. Payroll taxes are due within the first year of incurring the payroll taxes. Customer deposits come in here. So security deposits, if you're doing property management, they go in here. They're liabilities that you owe the customer back when they move out. any kind of customer deposits, retainers that they receive. All right, so anytime that you have some money that you possibly owe out to someone, or property even that you owe out to someone, and it's sitting on your balance sheet, and it's only going to be sitting there for about a year. Okay. After current liabilities comes long-term liabilities. These are things like car loans, bank notes, mortgages, notes payable, anything that is going to be sitting with a balance on your account for more than a year. Okay. Vehicle loan, you're most likely going to have a vehicle payoff is not going to be within the year. It's probably going to be a couple of years. That's a long-term liability account. Okay. After long-term liability, going down the balance sheet still, you're going to have your equity accounts. Okay. So if it's a equity account, equity is what is the amount of, if you take your assets, you subtract out your liabilities, you're left with what equity your business has. Equity also includes your net income. So when you run your balance sheet, it'll show your net income that you have. So if I go ahead in here and run, okay. The equity section down here, right now it only has my net income. The equity section is also where you put your shareholders' information. So track your shareholders' contributions, distributions, and accumulated earnings. Okay. The retained earnings box is here. Retained earnings is where year after year QuickBooks automatically rolls your net income into retained earnings. Right. If you have multiple shareholders, then one of your responsibilities is going to be to move the balance from retained earnings into the different shareholder accumulated asset accounts, accumulated equity accounts. Capital stock's also an equity, and of course you have opening balance equity here. Opening balance equity should always come out to a zero and then be moved to either the retained earnings account or be moved into or if it doesn't come out to zero, it should be moved to the retained earnings account or be moved into the different shareholder accumulated earnings accounts. Okay. That way it's distributed evenly, but it should not be sitting as a balance in opening balance equity. All right, so then we have next, we're moving on to equity is the bottom of our balance sheet. Then we move on to the profit and loss. All right, so the profit and loss starts, of course, with income. Income is money that you earn from normal business practices. All right, if you sell cars, if you sell services, if you discounts that you give to customers that they go in as a negative income. Shipping income can go in as income. So money earned from normal business operations is what it says here. Product sales, service sales, pretty self-explanatory. Then underneath income, you have your cost of goods sold. A lot of people think that they don't need to use this cost of goods sold, but I always push for my clients to use it. It's a way to segregate your business. So the way it should be used is explained again in another video here, but I'll go quickly over it. But we have your cost of goods sold should be a direct cost so what it takes, if I spend $1 on inventory, I expect to earn $2 in income. Okay, so it should be a direct cost to create income. Now then a lot of people say, well, marketing is a direct cost to create income. So should marketing go in there? But it's not a 1-to-1 or 1-to-2 ability there. Then also I hear clients say, well, what about payroll costs? Should payroll costs go into cost of goods sold? So it is kind of, you want to set it up the right way for your business, the best way for your business. But it is a way to be able to see, here's my income, here's my direct cost. So for every $1 I spent here, I made $2 up there. And then how many dollars do I have left for my overhead, which includes owner salaries, admin salaries, rent, utilities, all that fun stuff. So I like to segregate those out. I have a client that I do, a nonprofit client that I use cost of goods sold to segregate out their membership costs versus their admin costs. Okay, so instead of cost of goods sold, we have it cost of membership. All right, cost of memberships. And another one, if it's a service-based company, we have cost of services sold. Okay, so again, for every $5 that I pay my vendor, my 1099, I get $25 from my client. Okay, so that's cost of goods sold. That's next down. Then we come down to our expenses. Expenses you want to think of as overhead. All right, all the expenses that it takes to keep your company going. Not directly correlated to sales, but just to keep your company running. You need some office supplies, you have legal fees, you have rent expense, you have utilities, insurance expenses, payroll tax expenses, admin payroll. All of these are just general expense accounts. Okay. Then finally, we have other income. And other income are things like if you earn interest income, if you give a loan out to someone and it's not your normal part of business, but you're loaning them some money from your business and they're paying you interest. This is if you get income for having sold a fixed asset and you have a gain on selling that fixed asset, like selling a car. You make some money on selling that car. If you get reimbursed for insurance, for example, if you have a theft and you file your insurance forms and you get some money reimbursed to you on those insurances, these are all income sources for things that are not part of your normal business. You're not in business to claim reimbursements for insurance, right? So these are other incomes, other sources of income that come in that don't fall into your normal type of business. You want to keep these separate because you don't want it to show up on your income statement under income and then have a cost coming out of it. It's going to look like your business is making more money. If you get $10,000 back for insurance reimbursements, that looks like $10,000 in regular income that you had, and your income looks great this month. But no, it's not really our regular business income. We want to put it down under other income so we understand that this is not something that we can expect to happen frequently. Okay? Same thing goes with other expense. You have certain things, penalties, legal settlements. You have different types of expenses that are not related to your business or not related to your income and expense part of your business, okay? Things like penalties are non-taxable. A loss on the sale of a fixed asset, that's another expense account. So there's quite a few things, but you just want to make sure to keep them separate so that you don't think that that expense will filter in and should be part of your future budgeting. Okay? So those are the different types of accounts that you can choose in QuickBooks.